Welcome to this explainer. If you're a focused learner looking to truly wrap your head around the high-stakes world of international finance, well, you are in exactly the right place. Today, we're decoding the Singapore-India Double Taxation Avoidance Agreement. Most people just call it the DTAA. Now, on the surface, a tax treaty might sound like, a bunch of dry legalese. But what we're actually looking at here is a multi-billion-dollar story of international trade, incredibly clever corporate structuring, and intense government crackdowns. I want you to imagine having to pay a highway toll twice for the exact same road trip. That's essentially the core issue this treaty tries to solve for global corporations. It's a massive, evolving cat-and-mouse game where a single definition can dictate exactly how and where massive multinational corporations pay their taxes. So get ready, because we're going to see exactly how the rules of global wealth are written. So here's our roadmap for today's explainer. 1. The double tax dilemma. 2. Defining the business footprint. 3. The capital gains loophole. 4. Cracking down on shell companies. And finally, 5. The modern transparency era. Let's get started. All right, kicking things off with Section 1, the double tax dilemma. Okay, let's dive into this. International law isn't just some static monument carved in stone. It's a living, breathing document. To really understand why this treaty even exists, we have to look back at its fundamental intention. Imagine you're a Singaporean company doing business over in India. Without a treaty, India would tax your Indian profits, and then Singapore might turn around and tax those exact same profits when you bring the money home. To eliminate that massive roadblock of being penalized twice for the exact same income, the main modern agreement came into force back in 1994. But over the decades, it evolved, completely reacting to corporate behavior. The 2005 protocol opened up some major corporate opportunities, which was followed by a dramatic loophole closure in 2016, and eventually, these incredibly thick anti-abuse rules in 2019 via the multilateral instrument. This timeline right here, it's literally the pulse of international taxation. Moving right along to Section 2, defining the business footprint. It's one thing to say two countries are going to share taxing rights, but how do you actually decide which country gets the right to tax a business's operational profits? Well, the answer lies in a concept called permanent establishment, which is a term tucked away in Article 5 of the treaty. Let's go ahead and translate this dense legalese into a real-world concept. A permanent establishment is essentially the taxable footprint of a business in a foreign country. If an enterprise from Singapore sets up a fixed place of business in India and wholly or partly carries on its business through it, boom, they've triggered a permanent establishment. And once that footprint is established, India officially gets the right to tax the profits attributed to that specific location. So you might be wondering, what exactly triggers this footprint? The treaty draws a highly negotiated line here. It explicitly includes things like places of management, branches, offices, factories, mines, and even building or construction sites, provided those sites last for more than 183 days in a fiscal year. But on the flip side, it entirely excludes purely preparatory or auxiliary activities. Meaning, if you just rent a warehouse solely to store or display some goods, or you grab an office merely to purchase merchandise or collect information, you remain totally off the tax radar. It's a very fine line, right? There's a huge difference between just doing business with a country and doing business in a country. But hey, what happens when the money isn't coming from a factory at all, but from investments or intellectual property? Well, as always, follow the money. Articles 10, 11, and 12 of the treaty handle dividends, interest, and royalties. To prevent double taxation on these absolutely vital financial flows, the treaty actually caps the tax rate that the source country can charge at either 10% or 15%, depending on the specific circumstances and ownership percentages. These might seem like small percentage caps, but they are the exact valves that allow literally billions of investment dollars to flow freely across the Indian Ocean without being crippled by double taxation. All right. Here's where the story takes a wild turn. Section 3, the capital gains loophole. Now, what's really interesting about this slide is the dramatic plot twist driven by the highly controversial 2005 protocol. You see, the 2005 rules created a massive loophole. Capital gains from the sale of shares were to be taxed only in the seller's state of residence. So this meant if a Singaporean resident company sold shares of an Indian company and made a huge profit, only Singapore had the right to tax that capital gain. But since Singapore generally doesn't tax capital gains, businesses could effectively avoid paying these taxes entirely. I mean, no way, right? Billions of dollars were routed through Singapore specifically for this perk. Naturally, this triggered a massive government crackdown, resulting in the 2017 rule, which forcefully locked that door and handed the right to tax those capital gains right back to the source state. Now, when governments close a loophole that's this massive, they can't just pull the rug out overnight without causing total market panic, right? So they implemented a sort of controlled demolition phase-out. Step 1. Any shares acquired before April 1, 2017 were completely grandfathered in and still enjoyed that old residence-based tax exemption. Step 2. To kind of soften the blow for international investors transitioning to the new rules, shares acquired and sold between April 2017 and March 2019 were taxed by the source state but at a 50% reduced rate. And finally, Step 3. Any shares sold after March 31, 2019 face the full normal taxation by the source state. Which brings us to Section 4, cracking down on shell companies. You see, even during that transition period, governments only wanted legitimate, job-creating businesses claiming these benefits. They definitely did not want empty paper entities set up solely to dodge taxes. So, to distinguish a real operating business from a shell company, the treaty relies on a cold, hard threshold, $200,000 or 5 million Indian rupees. Under the limitation of benefits clause, you are basically deemed a shell company and entirely denied tax breaks unless your total annual operational expenditure in the resident state meets or exceeds this exact mark. You literally have to prove you are actually spending money and running real operations. But what if a company just fakes it? I mean, think about it. What if they just shuffle some money around to hit that $200,000 mark right before they sell their shares just to claim those sweet tax benefits? Well, to prevent that exact scenario, the treaty includes some incredibly strict legal safeguards. Honestly, you can't just rent a desk and buy a really expensive stapler. First off, your primary purpose cannot be tax avoidance. Second, you absolutely must have real and continuous business activities. And third, to prove that continuity, you have to maintain that minimum expenditure for a solid 24-month track record immediately preceding the gains. Actually, the only major shortcut to this expenditure rule, being publicly listed on a recognized stock exchange in either Singapore or India, because that automatically implies you have a legitimate operational scale. And that leads us perfectly into our final chapter. Section 5, the modern transparency era. The days of exploiting tiny technicalities and hiding behind closed doors are rapidly coming to an end. Enter the Multilateral Instrument, or MLI. Signed in 2017 and ratified by both of these nations by 2019, the MLI acts kind of like a massive global software update for tax treaties. Instead of going back and renegotiating thousands of bilateral treaties one by one, the MLI just overlays new rules to prevent base erosion and profit shifting, what tax experts call BEPS. It is literally the ultimate global antivirus patch designed to plug any remaining loopholes in that original 1994 agreement, applying a brand new principal purpose test to ensure benefits are only granted for genuine economic activity. Hand in hand with the MLI is the incredible evolution of Article 28, the exchange of information. Back in 2011, a critical protocol updated this rule, introducing the standard of sharing any information that is foreseeably relevant to enforcing tax laws. This effectively tore down traditional banking secrecy walls. The treaty explicitly states that a country cannot decline to supply information solely because it happens to be held by a bank, a financial institution, or a nominee. If one government requests foreseeably relevant data to pursue a tax evader, the other government is absolutely obligated to use its information-gathering measures to get it. Honestly, perhaps nothing captures this whole new era better than the newly updated preamble to the treaty, modified by the MLI. It states plainly that the treaty is intending to eliminate double taxation without creating opportunities for non-taxation or reduced taxation through tax evasion or avoidance. This includes explicitly calling out treaty shopping arrangements. The intent of the law is no longer just vaguely implied. It is fiercely and explicitly written in black and white right at the very top of the document. From a simple agreement back in 1981 to a highly complex, heavily enforced legal framework today, the Singapore-India Tax Treaty really reflects the evolving landscape of global commerce. We've seen how the definition of a business footprint dictates taxation, how massive loopholes were opened up and then dramatically closed, and how transparency is now the ultimate rule of law. So I'll leave you with this final thought to ponder. With loopholes closing worldwide and financial transparency rising to totally unprecedented levels, how will the next generation of global businesses structure their operations to remain both competitive and compliant? It's a fascinating challenge for the future. Thank you so much for joining me on this explainer. And as always, keep learning.